Hello again, economics students. In this video, we're moving on to how a change in interest rates actually impacts the level of aggregate demand. The way that they impact the level of aggregate demand is explained via these transmission mechanisms. It's how they transmit the change in the cash rate target into the level of spending. Well, first via the interest rate and then the level of aggregate demand or total spending in the economy. There are 4 transmission mechanisms or 4 channels, and they're all different, so they each have a unique way of working, but they will all do the same thing. So if the RBA increases interest rates, you should know by now that all 4 channels will work to slow down the level of aggregate demand, particularly if that increase in interest rate is over the neutral rate or above the neutral rate, which we'll talk about in the next video. And if the RBA cuts or decreases their cash rate target below 3%, so they take a more expansionary stance, all 4 channels will work to increase the level of aggregate demand. Now, I think this is best visualized using this little chart here. Over here, you can see that the change in interest rates has 4 impacts, 4 different unique impacts on aggregate demand. And the first 3 here, the savings and investment, the cash flows, the wealth and asset prices, all work to influence the level of consumption and investment, and the exchange rate channel will impact the level of X and M. But again, they all work to do the same thing. If there is an increase in the cash rate, they will all decrease aggregate demand, and vice versa. If there's a decrease, they'll all work to increase aggregate demand. Okay, let's go through the channels. The first one is probably the way that we've been thinking about interest rates up until this point in the course. It's the savings and investment channel, also known as the cost of credit. It's really about the reward for saving and the cost of borrowing. So if there's a change in interest rates, it affects the reward for saving and the cost of borrowing, and therefore the decision to save and the decision to borrow and spend or invest, depending on whether you're a household. So it affects both businesses and households, but the key thing here is this is really about the decision to take on new debt or to save money that you have or spend. So we're going to look at one, the next channel is a little bit different, but this is new debt. So have a think about this. I'll do the first one with you. You can do the rest. If there's an increase in interest rates, that means there is a increase in the reward for saving. So the savings rate goes up in your bank account if you have money in that bank account. The cost of borrowing also goes up, which means there's an incentive to save more and an incentive to borrow less. These 2 impacts here work to decrease the level of consumption for households and investment for businesses, and therefore decrease aggregate demand. Remember, the RBA is doing this currently because they're trying to slow down aggregate demand and achieve their price or low and stable inflation target. Okay, let's look at the next channel. The next one's called the cash flow channel, but it could also be called the discretionary income channel. And the key here is this is for households and businesses with existing debt. Now, in Australia, households and businesses have lots of debt. We have one of the highest household debt to income ratios in the world. And most of our loans in Australia, particularly households, have what's called a variable interest rate. Now, a variable interest rate just means that your interest rate will change based on what the RBA does to their target cash rate. So the bank will pass on those costs if the RBA changes the cash rate. There's another thing called a fixed interest rate, which actually means that your interest rate is fixed. It doesn't change. But in Australia, most people have a variable interest rate. So if the RBA is to increase, I'll do this one again with you. If the RBA is to increase interest rates or increase the target cash rate, banks will pass on the increased cash rate via an increased interest rate, and households have high interest repayments. I've heard of stories, and you can look at these up in the news, and you could probably ask your parents, of interest repayments going from like $2,000 a month over the last year to like $6,000 a month. Okay, so all of a sudden, we've got less discretionary income. Remember, interest is an essential. You can't choose to pay it. So we've got less discretionary income for households and a decrease in cash flow for businesses. We're basically saying the same thing. We're just using different terminology. These 2 impacts together work to decrease consumption and investment spending, and therefore decrease aggregate demand, and therefore bring us closer to our low and stable inflation target. The next one's a little bit tricky. It's about exchange rates. Remember from Unit 3, Outcome 3, that relative interest rates will actually have an impact on the value of the AUD. And that is because it determines where investors of big pools of money invest their money. I want you to just think about it as, where would you put your money if you had a choice of putting it in any country and you had a big chunk of money, and you could do that easily. Well, if the relative interest rate in Australia increases, which means we assume countries around the world don't change their interest rate, the incentive is higher to invest into Australia. Now remember, when anytime money comes into Australia, I'll draw a little bit out Australia here, anytime money comes into Australia, that creates a demand for AUD, because foreigners have to exchange their money for AUD. Now we need to then think, what does that do to the exchange rate? Well, if there's a demand for anything, bananas or currency, the price goes up. The price goes up of the AUD, we call that an appreciation. There's a lot of steps in this one. The next thing we need to think of is that if there's an appreciation, what happens to exports and imports? Because that's what's going to determine the impact on aggregate demand. We know that imports become relatively cheaper because our dollar's worth more, and the purchasing power of foreigners decreases, so they'll export from Australia less. Again, this will slow down aggregate demand. You can do that there. The last one is called the asset price channel, or the wealth effect. Basically, it's the impact on asset prices. Now, interest rates have a huge impact on the price of shares, bonds, and particularly property. If we charted the data of Australian house prices versus interest rates, you'd basically see interest rates going down and house prices going up. Now, the reason for this is when interest rates are lower, people get access to more credit because they're able to repay interest on a larger loan when interest rates are lower. Okay? And this is what's been happening up until recently, up until the RBA started increasing interest rates recently. So if it's easy to borrow money, and you can borrow more money than you otherwise would, this increases the demand for assets. In Australia, people borrow money to buy shares and bonds as well, but mostly they borrow to buy property. So if there's a whole heap of people out there that have heaps of money that they've borrowed to try and buy a limited amount of houses, well, you can think what happens. We get an increase in demand, and therefore the price of assets go up. Now, what does this have to do with consumption and investment? Because businesses have assets too. Well, it's the wealth effect, because it's how people feel. You can talk to your parents if they own a house or if they're looking to own a house. When you open the paper and you see house prices have gone up or down, it affects how wealthy you feel, right? Or if you own shares and you log in to check the value, it affects how wealthy you feel. And therefore, what you're likely to do in terms of consumption or investment. Now, you can put all that together in this one here because this video is going for way longer than I would have liked. But remember, the asset price channel is all about how interest rates affect the demand for assets, therefore the price of assets. And if prices go up, it makes people feel more wealthy. If prices go down, it makes people feel less wealthy. Okay, and therefore that will impact C&I. So if we put it all together, we can think about what the RBA is trying to do now. They're increasing interest rates so that via the savings and investment channel, people save more and borrow less. So sorry, there'll be a decrease in C&I. Via the cash flow channel, the same thing. People who have existing debt will have to pay higher interest repayments, and businesses too. So they have less cash left over to spend on consumption and investment. They're actually decreasing the value of houses, which they're talking about a lot recently, and they've been focusing on house prices, which decreases their feeling of wealthiness, and therefore C&I, and the exchange rate, they're trying to appreciate that, decrease X and M. All right, bye for now.